The US dollar rebounded against a basket of currencies last week as central banks and governments pledged masses of cash to reduce the economic impact of the coronavirus pandemic. The Fed over the past week took a series of steps aimed at addressing the dollar squeeze, including lowering the rate on existing dollar swap lines with major central banks and increasing the frequency of swap operations, while also establishing new swap lines with central banks for other countries. That obviously added to the dollar's rise, particularly against emerging market countries, where the collapse in the oil price caused downside pressure on currencies. The rise in the dollar led to more selling across markets that in turn reinforced the greenback's rise. The US dollar index, a measure of the US currency against a basket of 6 major rivals, edged down by 0.2% on Friday to end at 102.82. However, it posted quite a solid 5.5% gain for the week. Despite the surge in the greenback, bullish traders should be cautious as the rally could come to an end if central banks decide the dollar's strength is too excessive and damaging to their economies. Still, analysts say that DXY remains technically poised for more gains. Meanwhile, it was a bullish end to the week for the European majors. Although the common currency ticked up by 0.03% against the dollar on Friday, it still posted a considerable 4.3% loss week on week. The short-lived upside ultimately came from the ECB's asset purchasing move. The central bank announced plans to extend a €750 billion lifeline to Europe's businesses and governments to keep them solvent during the coronavirus crisis. It said it would launch a new program dubbed the Pandemic Emergency Purchase Program, PEPP, to buy up public and private sector securities on flexible terms. Meanwhile, sterling followed a similar path as the markets digested the rescue package. The pound gained 0.03% on Friday to close at 1.0695. However, it still logged a 4.3% fall for the week. Prime Minister Boris Johnson is expected to advance the coronavirus bill through Parliament this week, giving his cabinet unprecedented power to take all manner of actions, including the imposition of a national lockdown, similar to those seen in France, Italy and Spain. The charts suggest a continued corrective rebound over the coming days, although the trend is now against sterling. Elsewhere in the crypto market, Bitcoin price has started to show strength in its recovery since the Black Thursday sell-off in the prior week. But is this something we can expect to continue? Bitcoin closed at 6,205.8 on Friday, posting a 26% rise for the past week. At present, the price is holding above the middle of the channel, which is around $5,800. However, if this level fails to hold, then $4,200 is to be tested next week, analysts say. If BTC can hold $5,800 as support, then all eyes are on $7,200 as the key level to break out from. In commodities, Brent, the most widely traded crude benchmark, closed at $26.98 a barrel on Friday. Meanwhile, WTI, which largely tracks North American crude grades, settled at $22.63. US crude and Brent have both collapsed about 40% in the past 2 weeks since the breakdown of talks between the Organization of the Petroleum Exporting Countries and its allies, including Russia, leading Saudi Arabia to ramp up supply. S&P Ratings slashed its 2020 forecast for Brent and WTI to $30 and $25 a barrel respectively, from previous $40 and $35 a barrel estimates, citing severe supply-demand imbalance due to the coronavirus outbreak. Price forecasts for 2021 and 2022 remain unchanged, S&P said. Meantime, gold rose by 0.3% on Friday to settle at $1,484.60. For the week, it still posted a 6.6% fall. The decline could be explained by investors' stockpiling of cash. According to market experts, the overall concern here is how much more gold do investors need to sell to cover living expenses. It's a psychological thing where people continue to sell for cash. You've watched the combined review of financial markets on Insta TV with me, Anna Kasatkina. See you back soon.